it's been struggling to fully subscribe sale of its short-term securities to finance the budget, despite the increase in interest rates to entice investors. In fact, if you recall, the interest rates of the 91-day and 182-day and 364-day treasury bills are presently going for 16.78%, 17.42%, and 19.67% respectively. I'm going to show you something on the screen right now. This is why this is of major concern. In the 2022 budget, this is the central government fiscal operations. Total revenue and grants expected this year is 100.5 billion thereabout cedis. Total expenditure is 137.52 billion. That's about 37 billion deficit. So the overall fiscal deficit that we're seeing in the 2022 budget, that we're going to spend more than what we're expecting, is over 37 billion. Now remember, the total revenues and grants of the 100.5 billion, e-levy is included there. The e-levy that we projected to rake in some 6.9 billion is in there. And if the implementation of the e-levy begins in May, all things being equal, means we may not be able to reach the 6.9 billion. Domestic financing of the debt as we have it, the 37 billion deficit for this year, government intends to finance that deficit domestically by 27.9 billion, as against the foreign financing of 4.5 billion and some exceptional financing of 4.5 billion as well. You see that government is not going onto the international market so much because of the downgrade and other matters arising. Questions have been raised about how this 27.5 billion government intends to finance the domestic deficit is going to impact on the private sector, because it's going to be borrowing in the same space. I've been joined on Zoom by Professor John Gatsi. He is the Dean of the University of Cape Coast Business School. Professor Gatsi, good evening to you.
Good evening.
Thank you so much for connecting with us this evening. Clearly, from what we've seen, government is struggling to fully subscribe sale of the short-term securities to finance the budget, even though the interest rates are quite enticing. What could have contributed to this undersubscription that we saw in the latest release?
Thank you. I think it's as a result of the recent monetary policy measures that have been announced and being implemented. You notice that the policy rate has been increased, and as a result of that, the treasury bill rate has also gone up to 16.74 percent. That should have incentivized people, incentivize institutions that are allowed by law to invest in treasury bills. But if you compare that rate to inflation rate, it means that investors will actually be getting negative return. That is not incentivizing. So I would say that the recent monetary policy measures do not provide the incentive for investment in the treasury bill. Now, the other thing is that if you look at the portfolio of universal banks, investment, and other financial institutions, investment in treasury bill, that is much more than individuals. So while universal banks are looking at the other implication of the monetary policy or monetary policy measures taken, I'm particularly referring to the increase in the cash reserve. The increase in the cash reserve basically means that a portion of the deposit mobilized by financial institutions are not available to invest in treasury bill. So in terms of liquidity, the level of liquidity has reduced for the commercial banks or universal banks to be able to increase their portfolio into treasury bills. And that is the situation. Now, if you look at the increase in the treasury bill rate over some time now, you will notice about 16.25% increase in the treasury bill. And you will expect that should incentivize investors to make a lot of investment in treasury bill. But the basic thing is that financial institutions have been leading in investing in the treasury bill rate, and increased investment means negative returns to them, and also there is control of liquidity as a result of increase in the cash reserve or the universal banks. So that is the reason.
I see. Now, out of 1.9 billion, the latest issue, out of 1.9 billion, government got only 981 million out of the 1.9 billion is set out to raise. Now, that's almost a billion shy of the target. And also the fact that this 100.5 billion revenue target for this year, e-levy is in there as well. And the 6.9 billion that was projected to be collected from e-levy, if it kicks in May, we, all things being equal, may not be able to reach that target. Coupled with this continuous undersubscriptions, how much of a challenge is this for government in raising revenue or achieving that target for this year?
Well, that should be a great challenge in terms of expected mobilization of funds from the market. That should be of concern. But we also need to match this shortfall against the announced reduction in expenditure. If those expenditure cuts are real, then we need to match that and see what will be the net effect. So I think that is what government should be speaking about. And I think the government should also come clear, especially the finance ministry should come clear as to whether the current monetary policy measures are actually yielding the result that they want to achieve. Of course, there is a reduction in the level of liquidity to the universal banks, and their ability to purchase government bills has also reduced. Is that what they want to achieve at the end of the day? I think they should be speaking to whether or not the policy is meeting its expected result for the government.
Professor Gatsi, I thank you very much for your time this evening. I appreciate it as always.